If you're a startup founder who's planning to raise money, the first contract you'll probably use is called a SAFE. Most founders have heard of it, but very few actually understand how it works or what they're really agreeing to when they sign one. As a startup lawyer who's done hundreds of fundraisers, I've also been on the other side of this. I've raised venture capital for my own software company, so I've been exactly where you're at. That's why in this video, I'm going to break down what a SAFE is, how Y Combinator designed it, exactly how the key terms work, and what actually happens when your SAFE converts into equity. Because if you don't understand this before you start fundraising, you'll most likely give away more of your company than you need to. So let's get into it. What a SAFE is and why it exists. So let's start with what a SAFE actually is. SAFE stands for Simple Agreement for Future Equity. It's a template contract that was created by Y Combinator back in 2013. And the reason why Y Combinator created it is because before SAFEs existed, early stage fundraising was a pain for both founders and investors. If you wanted to raise money, you either had to do a price round, which meant hiring lawyers, negotiating a full valuation, dealing with a stock purchase agreement, and a bunch of other contracts, all of which cost a lot of time and money when you're just trying to get your company off the ground. Or you'd use a convertible note, which functions as a loan that converts into equity, but that comes with interest rates and maturity dates, and it adds complexity that a lot of early stage founders don't need. So Y Combinator built a SAFE to solve that problem. One simple short contract that lets you take investment without having to go through any of that. And since then, it's become the standard for early stage fundraising. Most rounds under 2 million are done with SAFEs now, and we're even seeing full seed rounds raised entirely with SAFEs, which was unheard of a few years ago. The reason it caught on so fast is because of how simple the process actually is. You can download the SAFE template off the internet, and because it's become so widely accepted, when you take it to an investor, they're already going to be familiar with the contract. So you're not going to have to do much negotiation around the structure of the document itself. The investor reads it, they sign it, they wire the money, and you move forward, sometimes in a matter of days. Compare that to a priced round where you're looking at weeks or months of back and forth, significantly higher legal costs, and a whole suite of documents that need to be drafted and negotiated. So that speed is a big reason why both founders and investors prefer SAFEs at the early stage. But the biggest benefit of a SAFE is that you don't have to set a valuation for your company. And that matters because in the early stages, it's really difficult to say your company is worth exactly 10 million. You probably don't have much traction yet. You might not have revenue, and there's no reliable way to pin down what the company is actually worth. So instead of having that valuation conversation, the SAFE lets you defer it to a later price round. Now, the way this works is you're basically asking the investor to give you their money and then later on figuring out exactly what their ownership looks like when a bigger investor comes in and actually sets a price for the company. When that priced round happens, the SAFE automatically converts into shares based on the terms you agreed to up front, which I'm going to walk you through in the next section. So the investor isn't buying shares today, they're buying the right to get shares later at terms that reward them for taking the risk of investing before the company had a set valuation. That's the core idea behind why Y Combinator created the SAFE, to make early stage fundraising faster, simpler, and less expensive for both sides. But before I continue, if you're currently preparing to raise and you want to make sure you're legally protected, I'll leave a link below where you can book a free consultation with me. Now, let's continue. The key terms inside a SAFE. Even though the SAFE is a template, there are terms inside it that you will negotiate with your investor. And you need to understand what these terms mean because they directly determine how much of your company you're giving away. The first term is the valuation cap. A valuation cap sets a ceiling on the valuation at which the investor's money converts into equity. So let me walk you through an example to make this concrete. Let's say you raise a SAFE with a 10 million cap. Then later, you go and do a priced round at a $20 million valuation. Your SAFE investor's money is going to convert at 10 million, not 20 million, because you gave them that cap. So they end up getting more shares for their money than the investors in your priced round. And that's the reward they get for taking the risk of investing early, before your company had a set valuation. Now, the lower the cap that you set, the more equity you're giving away. So this is something you want to be thoughtful about. At the angel stage, typical valuation caps are somewhere between 5 million and 10 million, but that depends on a lot of factors like your traction, your background, and your leverage in the negotiation. The second term is the discount. Instead of a cap, some safes offer a percentage discount on the next round's share price. The typical discount is around 20%. Here's how that works. Let's say your priced round prices shares at $1 per share. If your SAFE investor has a 20% discount, their shares convert at 80 cents per share instead of $1. So again, they're getting more shares for their money because they invested earlier. And some safes actually have both a cap and a discount. When that happens, the investor gets whichever one is more favorable to them. So if the cap gives them a better deal, the cap applies. If the discount gives them a better deal, the discount applies. This is something to keep in mind when you're structuring your SAFE, because you want to model out what the investor actually ends up with under both scenarios before you agree to anything. How SAFE conversion actually works. Now that you understand the terms, let's walk through what actually happens when a SAFE converts. When you sign a SAFE and the investor wires you money, you are not selling them shares in your company. You're giving them the right to get shares later at a future priced round. A priced round is when you actually sit down, set a valuation, and sell shares of your company at a specific price per share. That usually happens at the Series A stage. So here's what the full timeline looks like. You raise your SAFE with, let's say, a 10 million valuation cap. You use that money to build your product, get customers, and grow the company. Then you go and raise a Series A at a $20 million valuation. At that point, your SAFE converts. The investor's money turns into actual shares in your company. And because they had a $10 million cap, they convert at that lower valuation, which means they get more shares per dollar than the Series A investors. Now, here's something that trips up a lot of first-time founders. Even though you technically didn't set a valuation when you signed the SAFE, when you use a cap, the cap essentially functions as a valuation because the cap is what determines the price your early investors will pay when they convert. The only time the cap wouldn't matter is if your price round ends up at a lower valuation than the cap. But that rarely happens because the whole idea is that your company should be increasing in value over time. So when you're choosing a cap, you should think of it as choosing a valuation, because that's what it functionally is. This is why modeling your dilution before you sign anything is so important. You can use Carta's SAFE calculator. Legendary investor Fred Wilson calls SAFEs a nightmare because SAFEs seem simple but mask how much ownership you as a founder are committing, and it often only becomes clear at conversion. There are many stories of founders raising series of SAFEs and they didn't model the cumulative dilution and then were surprised by how much they were diluted. You want to know before you sign the SAFE approximately what percentage of your company the investors are going to end up with and what your cap table is going to look like after conversion. Because if you don't do this math up front, you can end up giving away way more of your company than you intended. Now let's talk about pre-money versus post-money SAFEs. This is the part of the video that I think is one of the most important for founders to understand, because this is where a lot of people get caught off guard. There are two versions of the SAFE: the pre-money SAFE and the post-money SAFE. And the difference between them has a real impact on how much of your company you end up giving away. So let's break down what each one means. A pre-money SAFE means the valuation cap is based on what your company is worth before the new investment comes in. A post-money safe means the valuation cap is based on what your company is worth after the investment is included. That sounds like a small distinction, but it changes the dilution math significantly. Y Combinator originally created the pre-money safe and then later switched to the post-money version. And the reason they switched is that with the pre-money safe, it was really hard to model exactly how much dilution was being given away. The cap table math got complicated, especially if you had multiple safe investors coming in at different times. So the post-money safe was designed to fix that. You can look at the post-money cap and know exactly what percentage of the company that safe investor is going to own, which is genuinely useful for both founders and investors. But there's a trade-off. With a post-money safe, the safe investor's ownership percentage is locked in. So if you go and raise additional safes or convertible notes before you get to a price round, all that extra dilution gets absorbed by the common stockholders. That means you and your early employees take the hit. The safe investors are fully protected from that dilution. Some lawyers in the startup space have pointed out that this is a pretty aggressive form of anti-dilution protection because it doesn't matter whether the later safes come in at a higher or lower valuation. The original safe holders stay protected either way. All of the additional dilution falls on the founders. Now, does this mean you should never use a post-money safe? No. Most safes today are post-money safes, and they've become the industry standard. But you need to understand what you're agreeing to, especially if you're planning to raise multiple rounds of safes before you get to a price round, because the dilution can stack up on you in ways you didn't expect. And this is one of the biggest reasons why you want to work with a lawyer who actually understands venture capital fundraising. Not just someone who can hand you a template, but someone who can model out your dilution and tell you what your cap table is going to look like 2 or 3 rounds from now. The fact of the matter is you're likely going to use a post-money safe because that's become the industry standard. Now, here are a few tips to not get screwed. 1, set realistic but high caps. Model the dilution and avoid stacking multiple safe rounds with different economic terms. Doing so creates unnecessary complexity and makes dilution harder to model. Instead, batch safes into discrete financing cohorts, with each cohort sharing the same valuation cap and economic terms. You can also lightly modify the language in the post-money safe under the definition of company capitalization so that founders don't bear all the dilution, but rather safe investors share in the dilution, so founders are diluted less. Now, if you're getting ready to raise and you want to make sure you actually understand the contracts you're signing and what your cap table is going to look like after conversion, click the first link in the description and book a free consultation with me. We'll go deep into your situation and figure out exactly what needs to happen so you're fully protected while raising capital. Again, you can book your free consultation with me by clicking the link below. And if you want to learn how to actually calculate what your startup is worth so you know what valuation cap to set, then watch this video next.